Hello, and welcome to the ConsistentOptionsIncome.com Pairs Trading Course, Lesson Number 4, Filtering Pairs to Trade. In the last lesson, we learned about what stocks we should consider including in our list of pairs. In this video, we will learn about how to filter trade opportunities after we have already identified our list of pairs. Let's get started. The first thing to be aware of is that we're going to be shorting stocks. One side of our pair will always be a short trade and the other side will be a long trade. When it comes to shorting stocks, we essentially have to borrow the shares from our broker before we can sell them short. So some stocks can become all of a sudden hard to borrow. If there's lots of people shorting them, all of a sudden the broker won't have enough shares to give you to short. So when we're placing our trades, we always want to do the short leg first and identify whether that stock is going to be hard to borrow or not. This is more a matter of execution than something you can research ahead of time. Earnings. We need to look before and after our trade to see if there might be some earnings implication. If some company had just announced earnings, it still may be coming from some surprise earnings announcement, and we may want to avoid that stock. We need to look at earnings after our trade, because if an earnings date is coming up, that could cause possibly some volatility in the price of our stock, whether it's short or long. This filtering is really based on risk tolerance. I personally do not filter out earnings trades. The main reason I don't is because during earnings season, you can lose a lot of your stocks in your pairs list that may have to sit idle for 2, 3, maybe 4 weeks to wait out the earnings on that particular stock. So your opportunities go way down during earnings seasons, and in reality the risk of earnings isn't quite as bad as most people make it out to be. It's essentially a 50-50 thing, and so over time we will have some stocks who report earnings, and that side of our pair, if it goes against us, will take a larger than normal risk. But also conversely, it works the other way. Sometimes we'll be on the right side of an earnings trade and it'll work in our favor. And it's usually not that dramatic. We always have one long and one short, so we have usually a sympathetic stock that may not be reporting earnings, but if a very similar stock has strong earnings, obviously the implications for the very related stock would be that they're probably having strong earnings as well. So we always have some sort of balance and a hedge in any event. And so for me, it's worth living through some difficult losing trades, because every once in a while we have a big winner. And over time, it's pretty much a 50-50 bet. And over time, we'll have just as many big losers as we do big winners. And so it balances itself out. So I personally don't filter out earnings. However, if you do want to worry about earnings before you place a trade, there's many places you can find earnings dates. You can look into Thinkorswim software, Zacks.com, Finviz.com, or Briefing.com. Now, dividends also play a role, and a lot of people are quite concerned if they're short a stock and a dividend's coming up. That means they have to pay the dividend. Well, dividends really don't amount to a whole lot of money to begin with, but what happens over time is that you'll pay just about the same amount of money in dividends from your short stocks as you get from your long stocks who are paid dividends. So I did a study for quite some time, basically a little bit over a year, and all of the dividends that I was forced to pay were pretty much equally matched by dividends that I received for my long stock. So in general, I don't really worry about dividends either. The main thing I do worry about is ex-dividend date. So I don't want to place a trade on the ex-dividend date. So if I'm not in a trade and the ex-dividend comes up and I have a signal, I'm going to ignore the signal because of that. However, if I'm in a trade and the ex-dividend is coming up, I'm not going to worry about it. So in the end, it pretty much works out to a 50-50 wash, kind of like the earnings. Alright, splits. When a stock splits, there's really no extra risk involved. You're essentially going to get twice as many shares as you had before, and the value usually doesn't change that much, so it's really not worth worrying about. The main reason that I keep stock splits on my radar is that it can be very confusing, because all of a sudden you started off with a certain number of shares and all of a sudden after the split you need to either exit or close, twice as many shares or something like that. Also, splits can happen in different ratios. So in general, if I see a stock split coming up for a stock that I'm following, I'll usually put that one on the side, or I'll check it right before I place the trade. And if a stock split's coming up in the next 3 to 4 weeks, I'll avoid that stock. Upgrades and downgrades. I think there's been plenty of research done on upgrades and downgrades to indicate that they're really not worth much. Some people put a lot of emphasis on upgrades and downgrades, but basically the analysts really don't seem to know anything, and there's a lot more upgrades than there are downgrades. So I think the market's wise to the fact that upgrades and downgrades really aren't that meaningful. So again, this comes down to basically a 50-50 random bet. So I wouldn't want to start filtering on upgrades and downgrades. However, if your risk tolerance dictates, certainly you could check the news on a particular stock before you do a trade, and if you see an upgrade or downgrade within the day or so, maybe it might be worth avoiding. Mergers and acquisitions. Now these can be quite significant, because if some company wants to buy ABC company, let's say, and it's one half of our pair, usually that buyout will entail a fixed stock price. So all of a sudden, one half of our pair is still being traded actively, and the other one now is pinned at a certain price. Also, it means that the ABC company that we were originally trading was in a certain line of business. Now it's maybe merged or acquired another company, and this could materially change the business that that company is engaged in, which may throw off the relationship that we're trading against, let's say XYZ company. So mergers and acquisitions are something that I really keep my ear to the ground for. You want to know these things ahead of time, obviously. If you're in a trade and it happens, you're going to have to decide what to do. It might make sense to close a trade sometimes, depending on what type of merger or acquisition it is. But it would be best to know these ahead of time. So it's good to keep your ear to the financial news sites. And if you hear anything about acquisitions or mergers, make sure it's not one of the stocks that you have in your pairs list. Other big news. So big news would be something like biotechs getting FDA approval, something like that. These big announcements could materially change the business of a company and throw the business relationship that we're trading out the window. So another situation could be in, let's say, oil exploration stocks, where they find a new huge source of oil, something like that. All of a sudden, their business has been materially improved when you compare it to the competitor that we're trading on the other side of our pair. So we want to keep our ear to the ground and monitor the news on all of our stocks that we're trading in our pairs list. Also, there's other news. Other news could be some sort of news about a company, again, that materially affects the business. For example, it could be something criminal, like maybe the CFO left with all the money in the company to the Bahamas or something like that. So this would materially change the company, or maybe the company's under investigation for something. All of a sudden now the relationship, the business model that we thought the company had is now materially changed when you compare it to the stock that we're trading on the other side of the pair. So there are sites where you can put symbols in and monitor news on just those symbols. There's usually a fee associated with a lot of those sites, but it is possible, and probably not a bad idea if you're trading a lot of pairs, to be aware of news that's happening. Upgrades, downgrades, mergers, other sorts of news. And they'd also give you stock splits. So it might be worth monitoring news on our pairs list on a routine basis. The other way we filter our list of stock pairs is from the signals we generate. Our trade alert service will alert you to situations where pairs are ripe for entering, and also will give you the exit signals when it's time to exit a pair. Now the entry is based on some proprietary signals that we've developed, and basically we're looking for strength or weakness in one side of the pair and strength or weakness in the other side. So ideally we want one side to be strong and the other side to be weak. That signals an opportunity for us to enter the pair as a trade. And as that pair resumes its normal business relationship, its normal trading relationship, all of a sudden we have an opportunity for profit. So we send signals when it's time to exit a pair. However, you may not necessarily want to take all of the exit signals. In other words, if you're at a loss on a trade, you may look at the pair and say it has some ample opportunity to turn into a profit, and you may want to stick with the trade. So primarily our trade alert service is going to be alerting you to good, ripe pairs trading opportunities. In addition, we have free software provided for NinjaTrader. This will be your double check before you enter a trade. In other words, we could have signaled an alert maybe an hour ago, 2 hours ago. Of course, our alerts are coming in real time, but if you're not at your computer exactly when the alerts come in, you can take an old alert, an alert that's maybe 2, 3, 4 hours old. Maybe it was an alert from the morning, and you place all your trades in the afternoon. You can take that pair that was alerted as an entry opportunity and put it into NinjaTrader. That indicator that we provide for NinjaTrader will tell you whether the opportunity is still available or not. Now, you don't have to use our trade alert service. You could use any indicator that tells you whether a stock is overbought or oversold, whether it's strong or weak. The main takeaway is you want to find opportunities in your pairs where one side of the pair seems to be strong and the other side of your pair seems to be weak. And what we'll do is we'll buy the weak one and we'll sell the strong one. That gives us the best opportunity to profit as the pair resumes its normal business or trading relationship. If you have any questions about the content of this video, feel free to contact me at john@consistentoptionsincome.com, and you can find more information on our website at consistentoptionsincome.com. Coming up next, Lesson 5, Entering and Exiting Pairs Trades.